Lesson 11, Trading Japanese Candlesticks. Before we get started, I'd like to point out a couple things. There's a sign in the top left-hand corner called Important Information. That sign is posted on certain slides throughout this presentation. There is some very important information on the slides where this sign appears. I think you may want to take the time to really understand and even perhaps memorize the information on that page. That information can help you tremendously as you learn to trade. The second thing is there's a number in the bottom center of this slide. It's called number 2. Please match those numbers up with the numbers in your workbook. If you lose yourself, just match the two numbers up and you'll be caught up with wherever we're at. There's 16 lessons on trading the Forex that can help you in learning to trade on the Forex. These lessons are also applicable in other financial markets because they focus in on technical analysis. One of the most profound statements I've ever heard was, successful traders will do what unsuccessful traders can't and won't do. Think about it. What's the difference between you and a successful trader? You both have 2 legs, 2 arms, 2 eyes, 2 ears, a head to think, yet you'll make totally different decisions. And a successful trader will consistently make profitable and productive decisions, and an unsuccessful trader will continually make unprofitable and unproductive decisions. Why? Because successful traders will do what unsuccessful traders can't and won't do. Successful traders will take the time to properly educate themselves on how the market works. They will then create a methodology, a clear methodology and habit of how to successfully trade, and they will stay disciplined to that. They will not vacillate or deviate much from their trading plans and methodologies. To where unsuccessful traders, they will do the absolute opposite. They will be in the market trying to get lucky. They will be in the market vacillating, changing their mind a lot. They will be very undisciplined. Discipline creates success. There is a 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original required information. This fact means this: if you listen to this lesson and you forget about it for 30 days, at the end of 30 days, you'll be only retaining about 3%. Our focus here at Market Traders is to help each individual trader, when it's time for them to get involved trading, to be operating at approximately 85 to 95% of the necessary information that they need to become a successful trader. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You'll learn how to read a trading chart and be introduced to the technical side of dealing with Japanese candlesticks. You'll learn that Japanese candlesticks give off buy and sell signals. You'll learn how to read and trade based on candlestick formations. You will learn how to create a trading plan when you spot a candlestick formation, and you will learn how to financially protect yourself in every trade. You will learn how to create a trading plan and trade that plan. I'd like to review reading the trading chart and placing orders before we get started. Once again, we're looking at Japanese candlesticks, which are monitoring the open, the high, the low, and the close of any time period, be it 5 minutes to a monthly chart. There are 2 types of candles. One is a bullish candle, one is a bearish candle. The bullish candle closes higher than it opens, and the bearish candle closes lower than it opens. Look at this chart. The market goes up, you'll see hollow bullish candles. The market reacts or comes down, you'll see black candles. They say the market doesn't go up and it doesn't go down. It's constantly going up and down, up and down. Be that as it may, the majority of traders watch bid charts. There is a bid and an ask when it comes time to trading, just like going to an auction. When you go to an auction, there is a bidder and there is a seller. The buyer is the bidder. The seller is asking for a certain price. The seller is offering his product for sale. That's where the terms come from. Most traders watch a bid chart, which monitors the lower of the two prices. The ask chart would look identical. It would only be 3 to 10 pips higher. Remember, we buy on the ask and we sell on the bid. Do not lose sight of this information. If this is the current price at 107.30 and we enter the market buying, we buy on the ask, which means we enter at 107.35 with a 5 pip spread. And every buy should have 2 sells. Our sell limit will be on the bid, and our sell protective stop loss order will be on the bid, which means if the market rallies up here, the ask price will hit the bid first. And if the market starts to fall, the ask price will hit this number second. The opposite will take place. If we enter the market selling, we sell on the bid. This is the bid price. We'd be filled at 107.30. We will place a protective buy stop on the ask, which means as the ask rallies, the ask will hit our protective buy stop first. Many traders think that when they short the market, when the market rallies, as long as the candle doesn't hit their stop order, they're still in. However, the ask will hit it first, potentially stop you out, and if it does fall, you'll need to check to make sure you are either stopped out or still in. But don't take it for granted because the candles did not hit it. Types of orders. There's a market order, which is an order placed at the market, whatever the bid and ask are. There's a limit order, which is placed at a certain number, and you will be filled at that number or better. And then there's a stop order, which is placed at a certain number, and you will be filled at that number, but it might be better and it might be worse, because when a stop order is hit, it turns into a market order and is subject to whatever the prices are at the market. Here's additional rules as you trade. Any order placed above the market or below the market, here's the market, that's where it's trading at right now. Any order placed above or below is called an open order, a working order, or an unfilled order. And if you place a buy order above the market, that's called a stop order. If you place a sell above the market, that's called a limit order. If you place a buy below the market, that's called a limit order. And if you place a sell below the market, that's called a stop order. Those are the rules that you will need to understand and memorize. It becomes natural as you start to trade. Another rule I believe in is that every buy should have 2 sells. Whenever you enter the market as a bull buying, you'll need to have a sell for profit and a sell for potential loss. Do not trade without a protective stop loss order. If you buy, every buy should have 2 sells, one for loss, potential loss, and one for profit. Every buy must have 2 sells. Conversely, the opposite takes place. Every sell should have 2 buys. If you're selling, you're shorting the market, your position is short, you're a bear, you'll need a buy stop for potential loss and a buy limit for potential profit. Every sell should have 2 buys. OCO means whichever order the market hits first, it will cancel the other. Whether you are buying or selling, as soon as you enter the market, you need to place a limit order for profit, a stop order for loss, and whichever the market hits first, it will cancel the opposing order, to where after that order has been filled, you don't have another working order out there. Cancel and replacing becomes a great way to chase the market in an educated fashion, not a greedy fashion. I focus in on effectively canceling, replacing in Lesson 16, trading strategies and their justification, as well as Lesson 3 on equity management. But remember, only cancel and replace to the new last low after the market has made a new high. The opposite takes place in cancel replacing as you're shorting the market. Only cancel and replace to the new last high after the market has made a new low. Bulls want to buy low and sell high. They enter the market first buying and exit selling for whatever reason, whether you're trading off of indicators or any sort of methodology. Our lesson on indicators, Lesson 4, trading indicators, has some great indicators to be used that help the trader know when the market is getting ready to take off and rally versus turn around and come back. But be that as it may, whether you're indicator trading or just trading out based off of candlestick formation and movement, bulls want to buy low and sell high. They buy first and sell second. Bears do the opposite. They sell first and buy second. You'll notice many times that the market comes down faster than it rallies. One of the reasons why is the markets are controlled by fear and greed. Fear is a greater emotion than greed. Because of that, prices drop faster, prices devalue faster than they rally. The great part about trading currencies is there are no special requirements in shorting the market. All you have to do is click the mouse and sell first and buy second. Even if you sell first and buy second, you are still buying low and selling high if you're going to make a profit. These indicator trades produce 350 pips in profit. One lot is $3,500. 10 lots is $35,000. Learning to trade currencies can be very profitable due to the leverage. But more importantly, technical traders learn to read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. And why do you think that is? The answer is this. People buy and sell in the market, and we are creatures of habit. And charts do nothing more than monitor our habits. Because we are creatures of habits, these charts have a tendency to repeat themselves, which then allows the average person to be able to go in, educate themselves on how these charts repeat themselves, and slowly start to predict the future. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a trading chart, you will start to control your financial future in the market. I'd like to review support and resistance briefly. Remember, highs have 2 candles to the left and 2 candles to the right that are lower than the wick high, and that not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. Lows have 2 candles to the left, 2 candles to the right that are higher than either the body or the wick low, and not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 focuses in on support and resistance and the financial game, but to the trained eye, you should be able to turn on a chart and be able to just scan the chart and find all your levels of resistance and all levels of support. So please understand that there is a financial game that exists. Bulls are trying to make higher highs and bears are trying to make lower lows. All protective stop loss orders must be at the last low if buying and the last high if selling. Let's look at this. For whatever reason, if we are buying here, our protective stop loss order needs to be at the last level of support. If we are selling here, our protective stop loss order needs to be at the last level of resistance. Do not trade without a stop. If the stop order is too far away from the entry point and does not meet your equity management requirements, pass on the trade and go find another trade. If you are buying here, look at how the stop order would need to be approximately 100 pips away or $1,000 at risk. Pass on the trade if the risk is too great. Now let's get started with lesson 11, trading Japanese candlesticks. Learning to trade Japanese candlesticks is probably one of my most favorite things to do, mainly because it's very simple, it's very easy, and it's easy to detect a candlestick formation. Reading Japanese candlesticks is not that difficult. Remember, at the beginning of this lesson, I pointed out that there were bullish candles and bearish candles, and all they were doing was monitoring the open, high, low, and close. Let's look at this again. See the bearish candles where the market is coming down and the bullish candles where the market is rallying? Well, there are several books on Japanese candlesticks that can help improve your trading. However, in all my experience, I've discovered that there's only four formations that are easy to recognize and easy to trade. When you put these Japanese candlestick formations together, they start telling a story and work on all time frames. The first one is called an engulfing candle. The second one is a morning star. Third, evening star. Fourth, doji star. And fifth, tweezer tops and tweezer bottoms. Now, engulfing candles are not what I consider to be good trading candles, and there's reasons why. I'm only going to focus in on morning stars, evening stars, tweezer tops and bottoms, and in spotting doji stars. But an evening star formation is a bearish pattern signifying a potential top, meaning if the market is rallying and an evening star starts to appear, that means that the market is topping out and is going to start to come back down. An evening star consists of 3 candles or more. I'm going to go into detail, but it is predominantly 2 bullish candles followed by a bearish candle. The morning star is opposite. This is a bullish pattern signifying a potential bottom. It is a bearish candle followed by 2 bullish candles. Morning stars come in many shapes and can consist of more than 3 candles. Now let's look at this chart. Here is the reason why many times in an engulfing candle, see how this one candle engulfs all these candles? Many times engulfing candles that engulf several other candles don't lend themselves to trading opportunities, because after the candle closes, it has already taken away much of the trading financial potential that is left. Now, here's a morning star. See how it has a bearish candle and a doji star candle followed by a bullish candle. Here's an evening star. 2 bullish followed by a bearish. There's the 3 candles. Here's a morning star. A bearish candle followed by what's called a spinning top, and followed by a bullish candle. These 4 candles make a morning star. I'm going to go into detail about these. Tweezer tops and bottoms are, the tweezer top is a bearish pattern